Are you a multifamily investor and you're wondering, how do I get my returns, or when do I get my returns on my multifamily investment? Today, I'm walking you through the roadmap on how or when you can expect your returns on your investment. So sit down, relax and enjoy, because I got you. One of the reasons why I'm talking about this is because of feedbacks or things I hear in the multifamily community, and I just realized that most times investors do not really understand the roadmap on when and how to expect their investment. So this is very important so that you can align whenever it was communicated to you to your goal, to your investment. But before we dive into that, I want to discuss the importance of understanding the risk level in multifamily investment. So not all deals have the same risk level. It's important that you understand different deals and their risk level and how it aligns with your risk level. Then that will now determine what kind of deals you should be investing in and the returns that you should expect on those deals. Like I will normally say, not all deals are for you. So choose the one that is right for you. I've classified the risk levels into 4 categories. So the first one is core and the risk level is low. So what does this involve? So these are high quality class A tenants in prime areas with very strong tenants. You know where you can find those kind of properties, so I won't go into that. So the returns typically on this type of deal is typically between 6 to 9% returns. And this type of deal is not for everyone. It's for very conservative investors that are looking for stability and long-term cash flow. So if you fall in that category, that means your risk level is low and you should be investing in this type of deal. The next one is core plus, and the risk level on this is low to moderate. They are similar to the core properties I described, but they come with minor issues, slight issues like underperformance, or they might need cosmetics to just bring them up to standard. The returns typically on this one is moderate. It's between 8 to 11% return on your investment. And what are the investors that are best for this type of core plus kind of category? These are for investors that want a balance between safety and some appreciation. Who wouldn't want that? The next one is value add. The risk level is moderate to high. Properties in this category require some operational improvement, renovation, or lease-up strategies to increase the value. And the returns typically on this type of investment is 12% to 16%. You can see the more the risk level, the higher the returns. This is good for investors that are seeking stronger returns and can take on some little risk. The fourth one is opportunistics. You've not heard that, right? Don't worry, you understand that shortly. The risk level on this one is high. These are ground up development, heavy rehabs, or distressed assets. Oftentimes no immediate cash flow. The returns are extremely high. They are really typically from 16% and above. These are really for experienced investors with very high risk tolerance and longer investment horizon. So if an investor brings a deal to you, or someone like me brings a deal to you, the first thing that you should do before you even start talking about the roadmap to investing is, does this deal align with my long-term goal? What kind of risk level does this deal expose me to? So I've mentioned the 4 different categories of risk levels, and I hope that with that you'll be able to identify what type of investment risk should I expose myself to and align your goal to it and start up your multifamily journey. So now let's dive right into what are the different types of common metrics in terms of returns that are communicated to us. Maybe when you go to a webinar, or they give you a pitch deck, or they give you a pretty memorandum, you see different metrics. What really are these? Some of the common metrics you will see in an investment. One is average cash on cash. And what is average cash on cash? It tells you how much you'll be earning from your investment every year. The formula is annual cash flow divided by the investment. So let's say you invested 100,000 and you get 8k every day. It means the cash on cash is 8%. So there's a caveat on that. So it depends now on the risk level of the deal. Let's assume it's a value add deal. Typically it takes between 3 to 18 months to stabilize a property. So if that is the case, it just means that the first 1 year will be very little or nothing. You should expect no returns in the first year until the property achieves stability. Maybe after 18 months and above, then your returns will start improving. The idea about multifamily investment is that it's a long-term goal. What literally is happening is that the property is improving by each year, especially if you have the right person doing the job. Hopefully the person bought the property well, and now the next thing would have been operation. So if the person bought the property well and is operating it well, then you should see a growth over the years that they've told you. So what I just want to emphasize here is that if they've told you an 8% and it's a value add property, it means that the property needs time to build value. So it means that the first 1 year you might get no return, or you get returns down the line. That is what it's really about. Don't forget that that is a caveat. So if you're told an average cash on cash on the pitch deck that was given to you in the presentation, it just means that the average of those years that the property will be held on to, you should expect an 8%. It does not mean that each year will be 8%. It just means that the average of it will be 8%. The next metric is preferred returns. This is just a way to pay the investors first. That is putting the investors first. It's a loyalty way of paying investors first. I'm bringing you as the sponsor behind. Although there are ways that a sponsor can structure it that after the investors are paid first, then they get paid. I'm not going to talk about that on this episode, but the idea is that you're putting the investors first. So how does that work? It means that if you are giving a pitch deck and you said they're going to give you 8% preferred returns, that means the GP, the general partners, or the sponsor, whoever is behind the deal, will not get paid until you get your 8%. Then afterwards, you guys can now split the remaining one depending on the percentage agreement that you agreed. So literally your 8% comes first, then every other one will now be split between you and the GP partners. The next one is the IRR. I'm not going to go in depth into this so that I don't get to confuse the new people out there. I'm just going to break it down so that you understand what exactly is IRR. This is the average annual returns you get over a period of time. In this case, you are factoring in the timing. That is, at what time are you getting your cash flow, your returns, everything. The bottom line is time sensitive. You are looking at the timing. At what point in time do I get this? So it takes cognizance of time value of money. That is what exactly it is all about. In this case, the earlier you get your money, the better the IRR. So if you are in that category of people that want quick cash, you'll be looking out for higher IRRs. That is what typically it's all about. So like I said, your risk level will determine what kind of IRRs you should be looking for when you are investing in a deal. So the lower the IRR, the higher the time period for you to get your investment back. Different investors fall into different categories. The last one I'm going to talk about today, there are so many, but these are the ones I've decided to talk about, is the equity multiple. How much will you multiply your money? That is what that is really all about. The way it's being calculated is total money received divided by initial investment. So it means that, for example, you invested 100k and you now receive 200k. That is a 2x multiple. That's what that is all about. So when you see an equity multiple 2x, it means that your initial 100,000, you get another 100,000 added to it. So you've doubled your investment. Literally, that's what it means. So now we're going to go into the cadence. I'm going to use the value add risk level to demonstrate this. So we're going to discuss the cadence on when to expect your returns. In general, once you understand the business of that deal, you should be able to determine when to expect your returns from your partners or from the GP members. So when a deal closes is a period whereby the general partner, whoever is behind the deal, starts to execute their business plan. Most times they spend a lot of money than getting money out. They are trying to improve the property, trying to make the property stable. Periods like that, you typically will not get a single dime. So when you close on a deal, don't expect a return immediately, especially in multifamily value add projects. You don't expect to get returns immediately because they will need to execute the business plan and bring the property up to a level that will start producing cash flow. So for that period, no immediate returns. After that period, it now moves down to the stabilization period. What happens at stabilization period? This is the period where the assets manager, whoever is operating the property, is trying to make the property stable. And in that period, yes, they're trying to make it stable. They're getting some little cash flow, but they are not there. In those periods, you are likely to get 0 to 2% during that period. Most cases is between 0 months to 18 months. During this period, if they've promised you an average cash on cash of 8%, you are likely to get 2% or even 3% or 0 between that year 1 to 18%. So don't be scared. Don't say, oh my God, what happened? No, what you should have done before that even happens to understand how the business plan aligns with yours. So the question you should have been asking is, when do I expect to get my first distribution on this deal? When you're told that, you'll be able to program and align and say, does this fit with my plan? And all that. You get what I mean, right? So after the stabilization phase, there's a cash flow phase. That is the place whereby the property is stable and cash flow is just coming left, right, center, middle. I know that's what we want to hear, but it takes takes time. It's not something that happens immediately. It takes some years, sometimes 2.5 years to 3 years. That is when you start to see a good cash flow. So if you're not that patient, is this the right deal for you? I'll leave that to you. The cash flow period is when cash will start coming. So if they've promised you 8%, you're likely to start receiving that amount in that year, and that is around 2 years to the 3rd year of the whole time when you started the investment during that period. And you typically will get to about 6 to 8% depending on the returns that they've projected that you're going to get during that time. And the next phase is refinance. In this stage, that is if the business plan includes a refinancing stage. Sometimes people just stabilize a property and hold it for 5 years and sell, but some people hold it for 3 years, refinance, continue holding it for maybe 4 more years or even 6 more years before they sell. But the idea is when the property is refinanced, what should you expect during that time? And during that time, you should expect about 30 to 60% of your initial investment. So if you've invested 100,000, you should expect 30,000 back to 60,000 back. Are there cases whereby you can get 80 to 100% back? That is your entire initial investment back. Yes, they are, but it's not something that is common. That is, the property will need to really appreciate to a very good level within 3 years or within the period where you want to refinance for that to happen. Has that ever happened? Yes, it happened recently when we saw properties appreciating above the value. These are periods like 2020, 2021, 2022. Properties were going way beyond the value. So if you had refinanced that time because properties were overpriced, you should have given them back their initial investment at that time. So after the refinance, what happens next is exit. You hold it for a little longer time before you now decide to sell. What happens during that time? What should you expect as an investor in terms of returns during that time? You can get between 50 to 100% of your initial investment. Why did I say 50%? Because some deals you are likely not to get back your initial investment back, or get nothing back, or get your entire investment back. For the cases whereby you did not get any investment back, or you got maybe 50% of it back, it just shows you that that was really a bad investment, or something went wrong, maybe from the GP member, maybe they didn't operate the property well, so they were not able to build up the property to that level, or their projections were wrong. They estimated they would get to this point, but the reality check, they didn't get there, so they were not able to get the property to get to that value. Another option might be that the market just played a fast one. Like right now, it's a difficult time now in the multifamily because of the economy. Like I always say, the macroeconomy plays a significant role in any investment. So peradventure they bought it right, they operated it right, the market also will play its own role. So if all those things are in check and everything is right, that means you are likely to get back 100% of your initial investment, and even maybe doubling your investment at that point. Literally, that is what it's all about. So these are my final thoughts. Multifamily, like I always say, is not a one-size-fits-all. So all you need to do is to determine where you are in your multifamily journey, what is your risk level, and choose a strategy that aligns with your goal. If you want help identifying the right risk profile for your next investment, let's connect. I look forward to hearing from you.